Hey, folks. Welcome to the Barometer Capital Management Barometer Readings webcast. It's Tuesday, December the 10th, my brother-in-law's 60th birthday. So we're going to be a little bit quick today. I've promised to surprise him at a party at 4:30 EST, so we'll move fairly fast. So I want to thank Amit Joshi for jumping in today. We're going to talk a little bit about the Canadian bank earnings over the past week. Financials are a big weight for us and have been all year long, so I won't really want to make sure we touch on that. But just from the top, as we've talked about for some time now, we're in a long-term structural bull market. This started when we exited this sideways period from 2000 to 2013. And along the way, we've had some interruptions. The most recent one came to an end in January of this year, where we exceeded the highs from December of 21. And we're now into our 12th month, working our way higher. And while it's been a great 12 months, very often it can be 3 to 5 years before we get to the next significant correction. We'll have to wait and see. But as we've been moving along here, markets have been broadening out and been pretty healthy. The S&P made its low in 2022 October. And again, with fits and starts, has been moving its way higher. And in the past week, we did make another all-time high. And we did same for the NASDAQ 100, which is certainly notable. Now, when we came into December, because November was a very strong month, up over 5%, there was a lot of stock for sale. Generally, when you have a month where equities have done as well as they have, there's some rebalancing to do in pension funds. So we've been working our way through about $50 billion worth of equity for sale. And frankly, the market's absorbed it pretty well. A lot of it has come in some of the very high momentum stocks. So we've seen little pullbacks sort of across the board. But again, the market has continued to be pretty friendly. If we look at the advanced decline line, the cumulative advanced decline line for the NYSE, it continues to show a very broad market. And we've seen that in our breadth indicators as well. When we move outside the US, the Nikkei, after consolidating here for about 10 months, is starting to move up and out of that consolidation, which is relevant. India, which had pulled back to the 50 week moving average or 200-day, held and has been working its way back higher again. And we've seen strength in a bunch of countries. Now, the reason that we talk about global stocks over the last little while, when most of us all have our money here in North America, is it's relevant when we look at valuations. So if you take a look at the MSCI All World ex-US index, it's about 895 companies. We can see when we compare it to the MSCI US index, on a bunch of measures, it's much less expensive. Now, arguably, there are some world beater companies in the US that you just can't replicate outside. But the differential between the two in valuation is significant, whereas the PE on a trailing basis is about 15 times globally, close to 30 times in the US. If we look at versus the average 5-year at 18 times versus the S&P at 35 times. If we look at price to cash flow at 9.9 times versus 20 times, you can see a bunch of these measures are basically doubles or more. Price to book at 1.92 times versus the price to book in the MSCI US index at 5 times price to book. So we watch this because it's really important to catch structural shifts and to be able to diversify. And while the US was the only game in town for a long time, there have been lots of interesting opportunities. We launched our global equity fund a year ago. It's up close to 30% over the course of the year. And this is a completely different list of companies than what we're seeing in our North American portfolios. So really happy with that. So, whether it's Taiwan or whether it's Argentina, there's things going on in other parts of the world that we want to sit up and take notice of. And especially when the lagging market, the Chinese market, has just recently reversed its long-term downtrend. And we now have 90% of the 2,200 companies in that index above their 200-day moving average. So that's a big shift. And I think is notable. Certainly, went straight up off the initial stimulus. This week, we got no more news out of the Politburo talking about a shift to an easy monetary stance in 2025. That's a big change. They've had a tight monetary stance since 2013, worried about inflation. That's 11 years. And again, we always say you don't fight the Fed or you don't fight central banks. Liquidity makes a big difference in markets. Now, in our global fund, we're close to 30% in China, and that's relatively new over the last 3 months. And we've had a lot of folks say, are you sure you want to have that kind of exposure there? And listen, I see all of the problems, just like I saw the problems in the US stock market in 2009. But ultimately, at some point, you get a clearing event and it can change the calculus. So it's not for us to say that the market is wrong. There are, in that universe of companies, some very good companies. And certainly as a diversifier, it doesn't hurt to have some exposure. So I recognize it's a lightning rod, but when you started with the US market breaking out to new highs in 2013, and one by one markets joining the rally, and now the laggard of the bunch getting a little bit better, it's significant and not bearish for equities. It's important to note. Even the TSX Composite Index, the Canadian stock market, after a long period of underperformance, is performing really well. In fact, outperforming the S&P since July. That has something to do with the sector exposures in the Canadian market, and frankly, in global markets relative to the US. When we look at the Canadian market, 32% of the index is financials, 17% energy, 12% industrials, 11% materials. That's a completely different makeup than what you see in the US, which is dominated by technology at 30%, consumer discretionary, and healthcare, which is almost non-existent in our home market. So when you get these sector moves, it's relevant. It's important to recognize the changes can go on for a long time. And so it's something that we certainly want to track. Just like we wanted to track the shift in interest rates that took place now almost 4 years ago in 2020. And since then, we've been seeing the 10-year Treasury bond and the 5-year and the 30-year mark their way higher in yields as we moved into a more inflationary world. And so for investors in disinflation during falling rates, the great hedge is fixed income. Fixed income in a world of falling rates. On the other hand, when you move into a world of more inflationary assets, a different type of asset does well. Now, arguably, CPI has come down here over the last few months. We're going to get CPI data in the US tomorrow and PPI on Thursday. It's important to note that historically, when you got into an inflationary cycle, after a sort of denouement, you had a second wave. And so it's something that's relevant. Where the expectation is that inflation will come in year over year at about 3.3%. Over the last few weeks, globally, a number of inflation data points have come in a little more sticky than people had hoped for. And we talked last week about the fact that often once you eventually break out of a range, when you do come back, you test the top of the range. And here at 3.3%, the expectations are now ticking a little higher. So just as we talked about last week, inflation has pulled back, but basically to the top end of the range it was in for several years. Something to keep an eye on. So when we look at this, what does this tell us? That the greater risk to investors is inflation eats your money. And if that's the case, we have to be cognizant of what it is that hedges against those risks. So certainly stocks versus bonds has been outperforming. S&P versus long-term Treasury bonds, steady march higher. Right? Companies have the ability to set price if they're the right companies. And dividend growth has outperformed bonds as well. And frankly, dividend growth has outperformed high dividend stocks, which act a lot like the bond market. But the other way to hedge is with harder assets. And this is the index of commodities. And it had a first move higher starting in 2020. We went through a tightening cycle, which frankly didn't move commodity prices down very much. And you can see all of the moving averages have turned and are now working their way higher. And over the last 4 months, 1, 2, 3, 4, they're starting to march their way higher again. So this is probably an indication of what we should expect. Commodity prices firming, that sort of goes along with a more inflationary environment, and certainly one we want to take note of. Now, in the S&P, materials are 3.5% of the S&P, and energy is about 4%. So why do we care? Because it has historically become much a bigger part of the index as a commodity cycle goes on. Energy has been up between 15 and 20% of the index historically. So it's something that we want to keep an eye on. Now, gold is the obvious one. After this long bear market, it broke out and it's been just marching its way higher as one of the very best performing assets on the year. Had a little pullback in the month of November, now firming back up in December. Silver, similarly, after breaking out, pulled back into this breakout point and now working its way higher again. So these are, I think, important things to keep our eyes on. So we compared stocks to bonds. Stocks is our preference. We compared commodities, the USCI Commodities Index, to the bond aggregate bond index. Again, very clearly, commodities outperforming. So why this week were they a little stronger? Well, first, the Chinese announced looser monetary policy, the first time since 2013. In the gold market, China resumed its central bank purchases of gold for their foreign reserves. And of course, there has been some geopolitical change in the Middle East, in Syria, and I won't try and analyze that other than to say probably the Middle East is more unstable today than it was a week ago, and we're likely to see change. And so certainly for people in that region, there would be a reason to want to own an asset like gold. So look, we don't have to be everywhere. And I say this every week. Our job is to try to identify opportunities in the key themes that are leading the market. And these themes change. We have to be aware that what has been working doesn't necessarily continue to work. So we got to watch for shifts. And in the absence of leadership, have a willingness to play defense. Now, as it is right now, we've been pretty fully invested. And we come at it top down, looking for the sectors and themes that are benefiting in the current economic backdrop. And it's not everywhere, but we want to identify leadership. And then we want to find securities from the broad universe of public securities that meet our tests and help us express our view. We're looking for investment opportunities in areas where breadth is expanding, where over time more and more securities are participating. So good that the US was performing well, better that more markets are performing well. It means equity asset class is healthy. And when we see deterioration in breadth, it causes to be more cautious. So in these areas that are leadership, we want to find the companies that are good getting better, companies that have strong fundamental characteristics, that aren't just getting better, but accelerating second derivative change in the rate of change, and where prices support the view, where prices are doing what we would hope they are doing given our positive view. So technically sound and fundamentally sound. And where we can find securities and parts of the market that meet our tests, well, that's where our portfolio should live. And then finally, when we do see negative change, that causes us to start stepping away from a group. Okay, so let's just talk from a broad base. Last week, we had a bunch of short-term indicators that were negative. As we sit today, didn't come up. As we sit today, our percent of stocks trading above the 50-day moving average, percent of stocks with positive weekly momentum have turned back positive. So we now have 4 short-term indicators in the US that are positive. All of the long-term indicators are positive. And we are into a month where there's a little bit less liquidity, a little bit less going on for a lot of people. The year is almost done. So we just want to watch for big changes. So without getting too granular, financials continue to march along. They had a big month in November. They pulled back a couple of percent over the course of this month. We're going to talk this week about what's happening in Canada because we do have a sizable bank weight in our Canadian portfolios. And this is the ZEB, which is an equally weighted basket of banks in Canada. Now, Canada's unusual marketplace. 5 big banks dominate the landscape, and they're all different. I've asked Amit Joshi to come on today to talk through a little bit some of the data that came out over the course of the earnings period, because you can see that performance varied. TD Bank on the bottom end, CIBC on the top end, and a mixture in between. So Emmett, maybe you can just give us some high level thoughts on who was winning and who was losing, and some of the things that we're looking at.
Sure, definitely. Thanks, Dave. Just to highlight and kind of bring it back to the comment that you made, when we're looking at companies to invest in, we're looking at good companies that are getting better. And that's the same lens that we've looked at the Canadian banks throughout the course of the year, within our focus of the banks that we own that have a more domestic exposure. So banks like CIBC, Royal Bank, and National Bank. All three of these banks have been the outperformers as compared to their Canadian peers, and have been, right in that theme of good banks that are getting better. Royal Bank is the most diversified of the Canadian banks, as per all the different business lines that they operate in, and usually a number one or number two market share leader in all those business lines. CIBC is the most domestically focused bank, has some U.S. presence, but not as much as their Canadian exposure, and they have been turning that business around. And same with National Bank. And both National Bank and Royal Bank have actually been doubling down in the domestic market and have both made acquisitions in Canada to further their strength in those markets. When we look at the quarter itself, I think it's interesting to see the domestically focused banks such as Commerce, Royal, and National Bank were the only three that actually beat consensus estimates on earnings per share, whereas BMO, Scotiabank, and TD all missed on that metric. So that's something that we're proud of from our fundamental work. We've tried to avoid the specific banks that have company-specific issues, be it their exposure in the U.S. With credit issues or underwriting issues, or TD with their AML issues. So we feel pretty good about that. We've got a good read through in terms of capital levels for the banks over the quarter, and all of them look great. And the metric of operating leverage, which is something we like to see, although we saw that tick up higher for the quarter for CIBC, National, Royal. This is them reinvesting into the business after being very strong in terms of expense management over the course of the year. So seeing them kind of drive that a bit higher in terms of marketing spend or compensation is not too surprising. And I'd point to that last column there, just the premium or discount to historical metrics. This is right bang on in terms of good getting better. These banks warrant a higher valuation for their execution, for the excellence that they've shown over the course of the year. And we don't shy away from owning that. And, usually when there is a bank that's trading at a large discount to its historical average, there's some underlying issues there. And, for us, the focus has been sticking to the banks that are working and focused on their domestic markets, and have been showing some excellence in terms of their operations and management.
I always find it interesting that, the leading companies in an industry have an easier time hiring the best employees. They have an easier time raising capital. They have an easier time remaining the leader. And while I know that Scotia is going through some significant machinations to change some of their operating models, and it may well be successful, it's still an unknown. And certainly TD is at a point where, it's really having difficulty, and you see it in the share price. I mean, after earnings release, Royal going and trading at a new absolute and relative new high, Commerce doing the exact same thing, and I compare that to TD. And I've been asked a number of times, when is it time to buy TD? I have to be honest, that is not our expertise, but we are never going to try and step in front of pick up dimes in front of a bulldozer trying to figure out where the turn is. So there's some really stark differential between them. Thanks very much for jumping on, Emmett. I really appreciate it today.
No problem at all. Thank you.
Moving on, we've had great outperformance in industrials all through the year. You can see over the last few days, we've been pulling back and testing these rising 50-day moving average. And we're seeing that as we've been seeing some of that pension fund rebalancing. If you look at the longer term picture, this is just working its way higher after coming out of several years of sideways trading, and lots of great companies in there. Internally, the percent of stocks trading in uptrends is almost 90%. So we will always watch to see some sign that there is deterioration, but certainly stocks pull back within trend. Materials, same thing, been sort of trading sideways, although I do think it's important that the metals and mining ETF broke out to a new all-time high in the month of November. And as often you do, you pull back and test that breakout point. I think that's quite favorable. We've seen a really nice bounce after a pullback in the golds. Agnico trading right back to the highs. Cameco pulled back a little off the highs, but again, these are big changes from the world that they've been living in. And so we want to recognize those changes, put positions on in the strongest stocks within these groups, and be there because we move forward. Pretty soon it's 2025, then it's 2026. And if we're in an inflationary environment, these things do well. We talked last week about the fact that the copper stocks had pulled back to an important area of support at this rising 50-week moving average. So far, they've held nicely and bounced off it. They certainly had a bit of a positive response to the Chinese news as well. And the energy producers, the big, long-lived energy producers continue to perform well. There are some U.S. producers that are having a harder time because, frankly, the growth in their production is not as strong and the asset life is not as long. We like what's happening in companies like Imperial Oil. These are monthly bars just marching their way higher. We're getting great dividends, great dividend growth, over 20% dividend growth. And we think that that will fuel us going forward. And that's a great hedge against inflation. Seasonally, as we've talked about, early December is when you get a seasonal bottom. And then generally January, February, March, April, May, June. It's very strong for energy. So we like our positioning there. Communications. Communications over the last couple of months. There's two groups that have stood out over the last couple of months that have really gained some traction. Communication services, and that's really, Meta in particular. But Meta, Alphabet, and Netflix certainly acting better. And the consumer discretionary group, now we've talked about 3 weeks in a row, really is on a bit of a tear. Just to put it in perspective, if we take the equally weighted consumer discretionary sector, taking out the impact of the biggest companies, the obvious ones, Amazon and Tesla, you can see that consumer discretionary relative to the S&P 500 over the last month has broken its downtrend relative to the S&P. So we always talk about recognizing change. And so over the last week, we've been adding selectively. We've added some Amazon. We've probably got more to go. But Amazon really standing out. If we look at consumer discretionary, the percent of stocks in uptrends, it's over 75%. And if you look at Amazon versus the S&P, it's making a new relative high versus the S&P, as is Tesla making a new relative high versus the S&P. So our companies, Costco, Loblaws, Dollarama, continue to perform really well. But it is clear that Amazon is a major winner. When we look at the traffic numbers that came out of Black Friday, obviously, and Cyber Monday, very, very strong. And we think that Amazon is going to be a big winner in the holiday season. So in simple terms, consumer discretionary equally weighted is making a new all-time high. And relative to consumer staples, offense versus defense, making a new relative high, speaks well to the economy and to the consumer. Things that aren't doing so well, consumer staples continue to relatively underperform. Healthcare continues to relatively underperform, not much to do there. REITs, pretty defensive, but not much to do there. Low volatility or high dividend stocks in general underperforming. So there are haves and have-nots in this market. Technology continues to relatively underperform and has since June. If I look at the semiconductor index, and I know I've talked about this a bit, but I am a little worried about this group. It's a leading group in the market and is now trading below all of the moving averages. Today was down about 2.5%, making a relative new low versus the market. It's an important part of the index. It's one of the reasons we don't really believe in owning the market cap weighted indices, because there are a lot of stocks in there that are big weights that may not be ones we want to own. I think you might find this interesting if I compare the semiconductor index to the Canadian large cap energy index. And here we're going back to 2014 long outperformance by semiconductors. There was a period in 2021 where energy got going. We went through the tightening cycle. Semiconductors came back, but here we are breaking to the downside, semis versus energy. So frankly, this is why we have more energy weight than we do technology weight. So when we put this stuff together and we look at the sector exposures, we can see that on our distribution curve, it continues to be that the broadest, strongest sectors in the market continue to be dominated by financials and industrials. On the other end of the spectrum, we're seeing healthcare continue to be very weak. We've seen some improvement in consumer. So leisure, for instance, has moved higher. And then a lot of sectors sort of stacked here in the middle, but breadth for the week was down about 0.3 of 1%. So the average sector just below 50% of stocks and uptrends 49.8. There's a lot of room for this to move to the right. In a healthy market, we should continue to see breadth improve, and we won't be overdone until you get to the point where 60, 70% of stocks are in uptrends, and we're a long way from that. So from a sector exposure perspective, not a lot changing. Financials, industrials, and energy, big overweights. Technology is significant underweight. Materials is significant overweight. And then defensive spectrum, really not very much exposure because frankly, we don't think we're getting paid. Consumer discretionary, this probably doesn't fully reflect what we've added in Amazon. This is coming up, and my guess is it continues to move a little higher. We'll see how we do through the holiday season. So things we watch for risk. Signs that bond investors think there is credit risk. Well, when spreads are narrowing or the excess return a corporate bond buyer gets versus a government, if it starts to widen, that's a concern. It's been narrowing now for 2 years. No sign of stress in the credit markets. Volatility, we've highlighted before. Volatility gets down to a lower range and stays there in cyclical bull markets, and that's where we are at the very bottom end of this range. So when we go back to the S&P, it looks like we continue to march higher. We're not expecting big changes through the month of December. Generally, you get small cap stocks doing a little better. Generally, some of the high momentum stocks back off a little, and some laggards get a bit of a bid as tax loss selling runs out of gas. But the truth is, when you come into December after a strong year, historically, December winds up being pretty good. So given that all of our indicators are positive, we're going to stay pretty fully invested. And if things get difficult, we're certainly happy to get more defensive. So with that, I'm going to sign it off today. I apologize, I can't take questions. If there's something we didn't cover, please reach out, send us an email, make a phone call. If you'd like to have a review, we haven't talked in a bit, please reach out. I was mentioning earlier in the week, we're really happy to have had Tiffany Harding join us, who's building out our wealth planning business. She's got about 20-year record of building very successful services in and around the investment services to work with some of the families that we're working with. So I'm very happy about that. And if I don't talk to you or see you before Christmas, the holidays, everybody stay safe and enjoy your families. Thanks, folks.